I think mistakes that a lot of property investors, property developers start with is that they're very project centric.
Okay.
They don't think about the wider business behind it. So they think, oh, I'm doing this project.
I'm going from project to
this
project.
is it, project to project, project. And that's, I think, in the first couple of years for us, we were probably doing that.
Oparo Social?
Oparo
Social, which is your social housing arm.
Yes.
Tell me about that. Tell me, how's it going?
I'll give you a quick overview. So 5 years ago, we joined forces with 3 other partners. So we are 25% shareholder in the business. The general scope of the project, I guess, was to buy assets, refurbish them, and then lease them with a social housing registered provider on a 10, 25-year lease, whatever it may be.
Which is a hot property, a hot strategy
It is
right
now,
Everyone
absolutely.
loves that.
Yeah. So 5 years ago, I think it was sort of starting that wave, kind of moving forward. So we sort of got on there early. We raised a significant amount of capital. It started at 6 million. It ended up at 2.5 million, which was part of the issues, and we'll sort of come into that. But we basically built the portfolio to around about 23 million pounds, about 140 units, and that could be a 6-bedroom HMO, or our largest scheme was a 24 unit asset in Croydon. All of these are sort of South London. And it's been fraught with issues, difficulties. It's been a roller coaster. So happy to dive into it now the scene has been set.
Amazing. I mean, I want to dive into it. What went wrong? What has gone awry? Tell me.
What hasn't?
What
gone
hasn't?
wrong?
Okay.
Yeah, so I always say, I have a phrase which I think helps with like mental sanity for a business owner.
Yep.
Only worry about the things you can control.
Yes, don't disagree
And
with that.
what we could control was the acquisitions delivery process.
Yeah.
What we couldn't control was the market, interest rates, Liz Truss, the housing association, which was our tenant, our funding partner. Pretty much all of those has gone just about as wrong as you could picture.
That seems like some
fundamental.
key moving parts.
So that's everything that we can't control, but everything has
Gone wrong.
been, I would almost say, like breaking point challenge for us. Some at different times and some all together. So Liz Truss decided to do the mini budget, and that pushed interest rates, which then pushed. This stock is based on an income yield play, so you get the total income, and because it's an income strip for 10 to 25 years, it's typical like pensions or drier investors that want to buy that income. Therefore, they buy at a yield, and when they're buying at a yield, we actually had an agreed sale at 5.5 of our net income, which fell through. One part of that, but also part of Home REIT, which is the market. They went into the public eye and they had to fold. And they were like the majority of the social housing market. Yeah. So timing on that sale and the market being a little bit
questionable.
In uproar. Since you said we're not allowed to swear, I was trying to and then Liz Truss changed the budget. So people in that buying space that leverage capital, they're now leveraging at 3 or 4% more in cost. Yeah. So therefore, our value went from 23 million to like 18 million, like a month. Which is difficult pill to swallow.
That's a bit of a drop.
Just sort of in terms of understanding how this industry works, Jack said it's based on income. So effectively, you take your income at, let's say it's £100,000 of income, a 5.5% yield sort of value. If you divide that 100 grand by 5.5%, you get whatever it may be, 11 million or no less, whatever that. Kind of maths in my head. But ultimately, if you were dividing it by a 7.5% yield, the value is lower, much lower. So if the yield market moves out, which it did, the value of the portfolio drops.
Crashes.
So we went from a point where we had an agreed sale in legals, we're literally just about to complete on the first tranche of 5.5%. And then it shifted to about, realistically, worst case, about 10%. And then it's been incrementally coming back down, and we've got red books at significantly less than that. So we're fighting that challenge, and then we realised that the registered provider that we're working with wasn't in it for the right reasons, and there was a bit of turmoil internally there. So we then had to take, at this point we had close to 800 grand's worth of mortgages per year, and we're now doubting whether our tenant is the right person to be paying us so that we could pay our mortgages. So we had to firefight to basically port from one registered housing association to another,
which feels like a big
without our overhead stopping. We can't say to the banks, by the way, we're doing this. We won't pay you until they start paying us. So that was going on. The shorter term project turning into a longer term project. We've had to manage expectations with the backer. So we're now actually looking for a backer to take a much longer position.
Sure.
Now the values are stabilising, and it's a secure, it's government supported income because it's paid via universal credit to the council, to the housing association, to us.
Yeah.
And it's fully repairing lease. So it's
Yeah.
quite as far as property investment
It
goes.
feels quite stable.
Yeah,
right?
it's
probably the most stable you'd
quite
sort of get.
light
Yeah.
touch. Yeah.
You plan every deal, every renovation, every exit. But have you planned what happens after you?
You spend years, everything you've got, building your empire. But if something goes wrong, all that hard work needs protecting.
That's why I connected with Away Wills, so my property portfolio was protected.
Dad, look!
For these rascals.
And the founder is a property developer, just like us.
Didn't even have to explain what an HMO was.
At Away Wills, we cut through the jargon and get to what matters, protecting what you've built and the people you love.
Contact Away Wills for a no-obligation chat about protecting your property empire today. www.awaywills.com.
You don't have voids. You've got
Yeah.
this
Yeah.
steady...
No maintenance.
Exactly.
Yeah.
You've got this steady stream. On paper, I do understand why this strategy feels really,
Yeah.
Yeah.
stable and good and a good bedrock.
Yeah.
But you guys have been the victims of a colossal amount
Few
of
issues.
Yeah.
bad luck at
Yeah.
each point,
Yeah.
I would say.
Yeah.
Yeah.
And ultimately with jumping ship from the registered provider that we were with,
Yeah.
with a new entity who effectively set up their London operations for our portfolio. So the first year of that was basically teething problems with them, with these leases, and the whole reason most people put their properties on these types of leases is it's hands off, and you sort of over to you, you're the operator, you do everything you need to do with it. With our portfolio, we were almost trying to manage that relationship as well. So it was never hands off.
Yeah.
And even now, we're still dealing with issues, whether it be with the operator, which has settled down now that they've got their management team in place, but then the council changed their processes, so that impacts the operator. So now we're dealing with Croydon Council. They almost went bust.
Yeah.
So effectively, everything that could have gone wrong has gone wrong, and we've had to wade through that storm. And this comes back to the point about resilience and pivoting and being able to firefight and solve problems. That's what you have to do. We've
right?
had to
Yeah.
roll our
That's the
sleeves
job,
up and
yeah.
get stuck in.
We haven't actually even mentioned that we went through one of the worst cost inflations in construction since we've been in delivery, but we actually managed that pretty well and stayed within contingency. So there's all of these amalgamation of problems that we had to face. We dealing with them head on. And then even, us having to put capital in from other businesses, it then forms a bit of a strain on that business because you go, we didn't see that coming.
Yeah.
Let's keep fighting the fight. So it's been far from a fairy tale.
But it's still there. Oparo
It's still
Social
there.
is still.
It is.
It hasn't folded. It's still
No,
an
we're still
entity.
there.
You're still there. What does it look like right now?
It's like a
What's the
misbehaved cousin.
Yes. Yeah.
It's stabilised now.
But you've got good family elsewhere, so
Yeah, it's stabilised. All of the assets are on to commercial, longer term, 5-year fixed
So you
type
have.
finance.
We have actually refinanced. And you guys
So
are-
there's income coming
Yeah.
in. It's a stabilised asset stream. There's still problems that we have to deal with, but ultimately we're in the process of now trying to restructure with our partners, bring in some new sort of equity as such, and Jack says sort of for the longer term. So a 5-year plus time horizon where somebody can come in with a seed portfolio where there's zero construction risk. It's all income generating. The RPs are there, the assets are there, and we can then grow the portfolio off the back of this seed portfolio. So that's the goal, taking what is £20 million portfolio at the moment to, let's say, 50-60 million pounds in 5 years time, and at that point you start to get to a position where the portfolio is large enough that some of the larger funds will take it and arbitrage that kind of value, whereas at the moment at 20 million, for example, most bigger funds don't get out of bed for that much, which is a shame. But ultimately we wanted to get it to that 50 million pounds from day one. We had a mandate with the registered provider that had 300 units. We were meant to be getting this £6 million fund that we could recycle. They ended up giving us 2.5 million at the time because of the things that were happening with Liz Truss and everything else. So they pulled the funding. So for the last 3 years, really, we've just been stabilising that portfolio and getting it to a point where we stop the leaky buckets, just get to a point where it's stabilized, and then we can figure out what to do with it.
But you haven't abandoned it, which
no, absolutely not.
I think that's a wonderful example of you both in terms of your character, and not, I mean, I'm sure many a person would have.
Yeah, I mean, even some of our partners have tried to throw in the towel.
A few
times. We've been like, look, no, this, we can get through this.
Yeah.
We have to get through this.
Yeah.
Let's roll our sleeves up and get stuck in. And
we don't see that as an option.
I think testament to you both, because like I said, a lot of people would have thrown in the towel and tried to get out of it and cut their losses.
Yeah.
So that's brilliant. Was there what was the reason you got into it? What because that feels like you've got this wonderful flow of all the different sort of points along the pipeline, and you're fulfilling something at each point, and then you've got social housing, which feels like it's different.
It's kind of the classic cliche, like if some of those things didn't happen, it would have probably been the best project that we were part of. Because if we would have transacted on the sale when we had it agreed, and it would have gone through, and
that's from a monetary perspective.
Yeah, and we won awards for ESG and giving back our product, and the people that we're housing. We actually had a message from one of our investors who we housed, someone that he met at a football game, and housed him for 3 months, and he got back on his feet. So it's kind of like full circle. I feel that where we have sort of surveying, design, development and management, it was always private residential markets. And you do tend to build a bit of a reputation of like, well, it's easy for you because you can afford to do that, or you can buy I'm grown up where a lot of my friends haven't been able to buy their first home, but I'm buying 6 on the same street. And to be able to then turn that into the product, which is government-backed secured income, month-to-month income. So it's like the HMO portfolio, but there's a slightly different angle on the exit because you can compress the yield and build a bigger portfolio. So it ticks all the boxes to be different, and actually the delivery was what we were brought in for. So we were brought in to look at a project, take it from A to B, and B would be a completely compliant, practical completion, ready for the Registered Housing Association to move in. So that caters really well to our skill set. So we could take it through all that product. We did all of that, and now we've had to expand into other areas of the business, take on everything. It's been more than we anticipated it would be, but we actually still, regardless, like the product and the strategy. And we would. That's why Ben said continue to grow it, because we know what we're doing now.
Yeah.
Back then we didn't. But we've learned along the way, and actually very little mistakes were made from lack of knowledge. It was more just changes in the market
external circumstances. Also, I would hazard a guess that if you've weathered that storm, I mean, touch wood, I should probably not say this, but I was going to say, what else could go wrong? I should definitely.
With the budget
exactly. We're heading into another budget, so watch this space. But if you've survived that, I feel like you've.
I mean, even from a government perspective, it's a very cost-effective way of housing vulnerable and homeless people.
Temporary accommodation is ludicrous. The amount of money that we save the government with the type of stock that we've. Like when you look at the figures, it's astronomical.
And it's such a brilliant thing to do. Let's also just go back to the sort of the social obligation that we have to society.
That message 2 days ago, somebody was, in a very, very, very dark place. And the message that we get saying, they've found a job, they're back in the place, they've met a new partner, loving life again, because of those 3 months that we were able to give them.
We actually housed them for free as well.
Oh, that's nice.
And I think we've spoken a lot about kind of diversification of our various businesses, and when you look at kind of our property portfolio as such, or what we do in property, we've sort of got a diversified portfolio of 3 buckets there as well, where you've got the social income, which is maybe it's only a 6%, but it's at that lower risk kind of more secure
regular and it's safe
type money. You've got the HMOs that might be 8 to 12% return, per annum, that type of IRR, and then you've got the higher risk 25-30% returns, which is the development. So as well as kind of spreading that risk across various businesses, we've also got within our property portfolio kind of a diversified portfolio within that sort of play.
So really, you guys are diversified in every way, shape or form.
Commercial as well, commercial property. We have some commercial stuff. That's another kind of lower risk, lower return type asset class. And maybe we could have focused on one first and done that and then moved on to the next, but we sort of
feel like it's working for you though.
We find value in anything. That's that as a my sort of viewpoint on property development is that we find value and exploit those kind of angles. We're not, we just do commercial to resi conversions, we just do HMO. Like, we see an asset and we're like, what can we do with this? What is the best way to get this into a useful life and add most value? I think that's the important
And
part.
a lot of it isn't rocket science. Most of it's real estate, if it's commercial or resi, and then what does the lease look like? But the way that we see it is it's all similar stuff. We did an office conversion, which we actually came runner-up with in 2021 at the awards.
At the Property Investors Awards. Let's plug that, shall we? 2021. Nice segue into my next section. Thank you, Jack.
But it's 7 offices and 7 flats as part of a development. And
but you didn't win for it.
But it was correct. But the reason we didn't win it is because the winner that did a nice scheme, we actually found the scheme for them. So we were actually beaten.
So you
by
should have actually, you kind of won
I
twice.
found both deals.
Okay. I mean, as far as I'm concerned, you're a winner, both of me.
But
that
was our first deal, and it had pretty much everything: new build and conversion, both residential and commercial.
Wow.
Selling of residential, letting of residential, letting of commercial, and we went head to head with a main commercial agent, and we actually ended up letting more offices than they did.
Yes.
So it just goes to show we like try and intuitively add value at every step of the way, whether it's through the project or through management or through marketing or whatever it may be. We just use common sense. We're pretty realistic with it, and we just try and.
Feels a bit selfish though. You've added a lot of value there. Like, that's like you're adding a lot. That's not just one thing. It was
all projects in one.
We
learned a lot in that one project.
Yeah, and that was your first project, you said.
That was joint first. Again, we ran 2 in tandem, but that was the first we found together as XP. Yeah,
wow.
It had everything. But because Jack's family, Jack's been managing. Sort of parents' commercial property for ages.
Of course.
I've done so many extensions through my architect. It's not an issue for me. So we can collaborate and have those skill sets, and the fact that it's got all of those in one is like, well, we can do this. It's fine.
But you were runner-up in that, but you won another one.
We did. The following year, we won Property Deal of the Year, was it?
Yeah, and that year we won HMO of the Year.
2021 as well. So you were runner-up and you won in the same year, 2021, and then in 2022 you won as well.
Yeah, so we won for one of our 6-person HMOs, which went to, we tried to buy it first. Do you want to tell the story? You're better at telling the story than I
So property went on the open market. We tried to buy it for 230 grand. It was an old sort of red brick cottage.
Whereabouts? Where are we talking in the world?
Just in Oxfordshire.
Okay.
So just outside Oxford. And anyway, we tried to buy it for 230. Someone else apparently outbid us at 235. So I said, let them have it. We don't want to go up. We always stand fast on pricing.
Good.
They didn't proceed and end up buying it. And I kind of, because it had been owned for 70 years, you kind of know that there's probably no TPC, no insulation, no EPC, all of that nonsense.
Yeah. You're going back to brick and working.
Yeah, so
up
we stood fast on our pricing, and I then refloated it. And I said, "Do you want?" And they said, "No, we're going to auction." And they set a reserve of 200k, and I said, "Well, I'll see you in auction then." And I knew where I could go to, and we ended up buying it for £208,000. And then there was some auction.
Taken the 230, guys.
Exactly, and there were some auction fees on top of that. But that's really cheap real estate because we converted it into a HMO after that, and it did really well because we bought it for such cheap value. I think we spent about 100k on it, revalued at just under 450 to 500, I think, and then it just fell in part of the portfolio, and it's still running today.
And that's your award-winning.
That was an award-winning HMO.
HMO.
Yeah, and then the big development that we won,
and that was in 2022, the next year. Talk me through that. What was that?
That was sort of height of COVID. Things it came on the market.
Of course, 2022.
It came on the market at £2 million. It was a block of 14 flats. So
again, where in the world are we talking?
Same place.
Okay,
actually.
Oxfordshire.
South of Oxfordshire. South of Oxford. Block of 14 flats, an old kind of mill house. In the same ownership for 50 plus years, tired, needed a bit of work to it.
Brick
was more of an asset management type play. So came on for 2 million. We got it for just over 1.5.
Wow.
We spent no more than £450,000 like asset managing it. So we did, most of our stuff is quite a lot of big development or heavy conversion works. This was move a couple of tenants out, get in there, liquor paint, new kitchen, new flooring, that type of thing. So
we're not
tenants around.
The biggest
thing we did was a loft extension. So So we
so really not.
I mean, it was a big loft. It was a big loft
from a
conversion,
2-bedroom flat to a 4-bed HMO. So 5 dormers, re-roof.
It was a big loft.
Tin hat.
Yeah,
it was fairly big, and it had a really, really dangerous external staircase that was like this.
Oh yeah.
As we moved that internally, got the new staircase up, and then the rest of it was the asset management. So moving those tenants out, we took the rent roll from I think 100 grand to 190.
87,000 to 197,000 within a year.
Over doubled the
wow.
rental income.
So 87. So numbers being purchased for 1.5.
Yep.
Spent
less than $500,000.
Less than $500,000,
including acquisition costs. Because we bought the limited company rather than the assets, so we saved a huge chunk on stamp duty as well.
Oh, that's nice.
Yeah. And we took each individual rental maybe from £600 per month to £1,000, £1,100, £1,200. So almost,
So you're doubling.
That's where we're
doubling the
rent
basically.
Because it was tired. It needed lick of paint. It needed.
But it was a lick of paint. It wasn't kind of redoing.
Some were back to brick.
Okay.
Some were literally like a lick of paint.
Yeah.
And
yes, we were spending 25 to 50 quid, 25 to 50 grand per flat, just tarting it up and bringing it back to useful life and in a good specification. So
and how long did it take? How long was the whole
about 18 months end to end?
Okay.
Yeah, because we were moving tenants in and out.
Yeah.
But we bought on higher than a 7.5% yield on where we're delivering the scheme.
Yeah.
And the debt that we bought the site with, which was a development product, so they lent us day one and then they lent us all the build costs drawn down in arrears, was at 7.5%. So we could have taken as long as we wanted in the delivery of it. So we knew that we had the time, so we actually capitalised. We pretty much negated our finance cost by rent roll.
Yeah.
And even some,
even
some flats, we sort of said, while we're in this development facility, we need to redo your flat.
Yeah.
And then they'll be like, that's fine, I can go and live with my mum for a few weeks.
Go save mum for a few weeks.
And then we'll
and I've got a nice,
and do what we need to do.
New look of paint.
Make sure there was, electrical boxes need to be upgraded to be compliant with modern day and things like that. So we went through all the flats, and the only major works was converting the top floor flat to a 4-bedroom HMO. Everything else is pretty much the same.
Yeah. Big loft conversion.
Exactly. All in for about 2 million quid, and then we got it revalued at 3.4 million. Well, 3.415 million quid.
Wow. So 1.5 mil, give or take, added value in 18 months.
Yeah, and really simple. Yeah,
way more simple than a lot of the other stuff we've done.
Yeah,
we want more of those.
Yeah, that sounds lovely. Sign me up.
Yeah,
but it is. It's still a lot. 2 million. It's not a, semi-detached up in the outskirts of Liverpool that you can buy for 40 grand. Like it is big finance. Where are you finding that? Private investors?
Private investment, yeah. So £500,000 worth of private investment is what we had on that. And that was with, a private partner of ours. Almost all of our schemes we've done with external investment. So structured in various ways, but typically kind of investor brings the funding, we bring the asset, the expertise, the delivery experience to deliver it, and we'll split that profit 50-50.
Are you going 50-50?
Typically how we structure it. Sometimes that investment comes in as debt, so we might own 100% of the asset. We might pay a fixed coupon on that investment money coming in, and really those two options are typically how we structure our deals. We're getting to a size now where that might have been our 500 grand might have been our typical investment level 3-4 years ago. We're buying two bigger assets that are £2.5 million investment, £4 million purchase, £5 million purchase. So we've sort of gone through the gears of different types of investors, and I think we're now slowly getting to grips with the new level of investor that we need. We still often have opportunities for that sort of 200 to 600 grand type level, but most of our bigger developments now are £2.5 million type investment.
So you're not saying no to the smaller investors, but you're really focusing on the kind of 2 mil up
for our bigger developments, yes, but because we've got everything else going on, Jack's CSL portfolio builder, we've got our own assets that we hold. We've just converted a doctor's surgery which we bought for 350 grand.
Right.
It's worth 1.35 million now. We've just refinanced it. We raised something
cash?
like 275 grand's worth of investment. I think we got in on that one, so we'll be repaying that investment once we refinance. That's happening at the moment. So we've always got places to place funds. But we're now sort of trying to do, I guess, 2 larger developments alongside some of those smaller things that we might put in our portfolio.
And that presumably will take a lot longer.
Yeah, they're 2-year type programs in and out.
And conversion? So I was going to say, what is it? Is it office to resi? What conversion?
So this particular one is in southwest London. It'll end up being about 24 units by the time I'm finished with it. GDV of about 12 million. Yeah, once I've optimised it and maximised it. And
12 million GDV.
12 million GDV. Yeah. £2.5 million investment we need for that, and it will be PD office conversion, so class MA.
And what sort of, just, in case anyone listening to the podcast is sitting on a cool 2.5 to 3 million, what sort of returns do you tend to offer your investors? Are you able to go into that? Yeah,
I mean, we can't sell a deal unless it's sort of a 20% IRR. So, let's say it takes a two-year time frame. That's a minimum of a 40% return on investment for that 2.5 million.
Yeah.
And that would be the minimum that we would.
That's a very nice return.
So how our acquisitions process works is where Ben says sell a deal. When we're looking at a deal, we're looking at its own merits, how we buy the site and can we deliver it for ourselves. The bank typically want to see a 20% return on gross development value. We also have our own internal stress testing model on our spreadsheet, which I actually stole off quite a well-known bank underwriter.
Right.
He was at the judge's day, actually, wasn't he?
Yeah, so I stole his stress testing profile. This is years ago. But then from the investment perspective, where Ben mentions is for us to get an offer. So by the point I'm offering something, maybe weeks or months before an investor's even got it in front of them, I need to make sure the returns match a criteria for what the market will typically pay.
Yeah.
We typically do a 50-50 split on the profit. So it's open. We don't know exactly what we are going to get, because given our sort of track record, we can show that by the time we've sweated the asset and played around with things, and we typically outperform the spreadsheet at the beginning because we want to know the sort of base case.
Yeah.
But looking back at our track record of deals that we've delivered, we have hit significantly higher than 30% annualized on capital.
Wow.
On half of the profits.
And investors are coming back and back. Are you seeing that? You sort of will see
we don't
them
have
recycle
problems with.
You don't have problems finding investors.
Yeah, it's almost a pain sometimes because our investors go, I really like the deal, but I'm already in on a deal or two, and I can't come in on.
Yeah, I've got no more cash, basically.
Yeah, the award-winning deal that we just spoke about, that investor is now on a £7.5 million GDV scheme just around the corner, which will end up being 23 units. February next year we'll be finished on that. So it went from the 14 unit scheme with $500,000 to close to 1.2 million-ish on one of the other schemes that we moved on to.
Are they just recycling? Like, as in, do you even give them their cash back, or do you sort of go reinvest?
On refinance of the award-winning deal, we paid back most of the investment to the investor, and some of that's gone towards the next one.
That is a site we kept though.
Okay.
So if we'd have sold that site, they would have got the capital and profit, and we would have done the same.
Right.
Yeah. We're working with an investor at the moment who did find us through one of the podcasts like this from the Property Investor Awards back in 2022. So this does work.
It does work.
It absolutely does.
Big shout out to the Property Investors Awards.
No small fry as well. Yeah. That's over £1 million investment. So
wow. Okay. Yeah. It is all about networking. Put yourself out there, isn't it? It is partly salesy, I think, just in terms of making sure that you're showing yourself. You can't hide in the shadows.
You never know where some of these people come from, and some people have been watching. It's quite not stalkery, but they might have been listening to our podcast for a year before then reaching out or coming to. We had an investor open day last week at one of our schemes in Muswell Hill, and only after that visit are we now having conversation about investment,
trust.
But they've been watching us for 2 years and following what we've been up to, and you just don't know when that's going to come.
And if you hadn't been out there, then you would
wouldn't know about us.
Yeah, I wouldn't know about you.
Every property investment starts with a vision. Once your vision becomes your reality, it deserves the right protection. Whether you're building from the ground up, managing investment properties, or growing your real estate portfolio, Horner Blakey Insurance Brokers helps protect your property and business at all stages, because great investments deserve expert protection. Horner Blakey Insurance Brokers, specialists in protecting your future today.
So I'm so conscious of time because I could actually sit and talk to you both all afternoon. I want to just touch on, we've talked about Property Investors Awards, your winners. Love that. You're now judges, which is exciting. Is it fun? I want to know. Tell me about it. How has it been going from applying, winning, and now getting to the shoes on the other foot?
It was fun to see how we were judged, and what people might have been looking for in our schemes and why ours won over others, for example. But we had the Judges' Day a month or so ago. It was just, I think, quite good and interesting to hear different points of view. We obviously have the way that we do things and things that we look out for, but listening to the other judges who again are ex-winners and other people that are in the property industry, how they approach deals and what's good for them, and actually helps us, I think, in the way that we sort of
so
analyse.
You're learning as well.
Yeah, we might change the way that we present something because actually it might not cater for the type of person that's this risk profile, or differences of opinions are always welcome. So I thought it was a really good day.
Great.
Yeah, I think from just trying to wind all the way back to 2021, which feels like ages ago. I can remember that we had been operating in business for 4 years, sort of doing property stuff, and everyone just in our own close family and friends just see us these little busybodies that think we're the next Elon Musk. But in the actual that's their opinion not without looking into the scope of actually what we do. Whereas I feel that when you win, like we won HMO of the year, we came runner up for development of the year, and then the following year we won deal of the year, you actually get some appreciation that you're doing the right thing in your own industry for the people that aren't in it.
Legitimacy.
Because the property industry feels quite small. A lot of people know a lot of people, especially now with social media and everyone's podcasting, and you can sort of get to know what people are up to. But I feel that was one really valuable thing that we've actually got some silverware in the office, and people are like, oh, okay, this is
what you're
legitimate doing. You're not just trying X, Y, and Z, because a lot of them don't necessarily understand what we do, because there is a lot going on, as you can probably picture.
I've definitely felt that over the last hour. So if anyone listening is wanting to enter the awards, what would your top tips be?
I think be as detailed as you can in your appraisal and the information that you submit. There's a lot of sort of discounted potentials because they're missing key information. So
and did you see that a lot? Did you
there's a couple of that where it's like,
Mr. Trick,
don't quite understand this, or the figure's missing here or whatever. I think look at all the previous winners, see what they've done, and also reach out to them. If people reach out to us saying, look, I'm looking to submit something, can you have a quick look at what we're about to submit for any pointers? Happy to do that.
That's gold, by the way. Everyone listening should absolutely do that.
You're
inundated with people wanting advice now.
Well, why not? Ultimately that could be an opportunity for us as well. Those sorts of people, and building relationships with, if people are putting their projects forward for the awards, they must have done some pretty decent stuff.
For sure.
Why wouldn't we want to kind of be connected and see where things lead? Because if I've learned anything in the last 8 years, it's your network that can help sort of open doors and opportunities for you. So
absolutely,
we're always open to that, and that's why we do our own podcast and get out there and speak at events and things like that.
Great.
I would say don't start unless you're willing to do it properly, because you do see applications where you're like, chucked it in. I will say, I do think the judging is extremely robust. I've seen other, and I'm not sort of downplaying, but where it just might be one person in a category deciding. And what I learned for the Property Investor Awards is when you've got 50 industry leading people from various different backgrounds arguing about why it's good or bad or ugly, it really does build a robust standpoint on actually probably what is the people's favourite rather than a person's favourite.
And it's knowing when you have won that award that it is so well deserved to get through that scrutiny. I think is brilliant.
Yeah, the awards night. I mean, we didn't expect it to win, do we?
No.
But when we did, it was a real buzz.
Yes.
Hearing your names, oh my god,
yes, I do remember that. It was a very nice feeling. Right, final question. Back to Away Wheels, show sponsor, my company, obviously biased. What does legacy mean for you both? You have children, so are you building this to hand on to them? Are you going to spend the money, write them out the will? What's the thoughts on that?
Yeah, I just want to make sure that the family are catered for, really, and that if they want to go to uni, they've got the cash. I come from a very working class background. I had to get grants and stuff to go to university, and for me, not being able to go on school holidays at secondary school, because that sticks in my head as like, I don't want my sons to have to go through that. I'm not going to be splashing the cash and giving them everything they need. They're going to have to work for it, but I want the money to be there to enable that if the time comes. So there's definitely an element of building something for passing down, and just making sure that we're comfortable and can fend for them when they need it.
Yeah. What about you, Jack?
Yeah, it's an interesting question. I've just signed up for a debenture at Twickenham, and you put the cash in, and it stays in the RFU for 85 years.
That's a long time.
Which is basically beyond anyone that can afford to spend that money.
Yeah.
Is never getting it back themselves.
I was going to say, that's not for you.
So it's. I was thinking about this the other day. That just immediately goes into the family. But I think I'm similar to Ben in the proviso that. So my dad is an extremely sort of shrewd, hardworking businessman, probably too sort of rough around the edges, and has always made us work for what is due. And having grown up in that environment, I think that's really important, because you don't value whether it's time, money, people, relationships, business growth. But if I wanted to talk to him about potentially funding a business idea, or giving me time for a business idea, or making an introduction, he's always been there to support that. So I think that I'm purely going to focus more on what my family focusing on their passion and enabling whatever that is that they can deliver on that. Some might be racing car, which costs £1,000 a year, and we'll figure that out when we get there. Some might want to be a hippie and travel the world and want $5,000 a year, but I don't know. But for me, I think passion is the main driver, and as long as I can facilitate them to enjoy their passion, that'll be enough.
I love that. That is a perfect way to end the podcast. How can they, the viewers, the listeners, find you? XP Property, tell me socials, and we'll pop it in the show notes.
Yeah, Ben Richards _property, XP Property on all the platforms, the Property Experts podcast on YouTube.
Yep.
Yeah, and I'm at Jiggens Property on Instagram.
Perfect.
And then, you can just
We'll pop them all in the
us.
show notes. We're everywhere.
SEO does a great job.
Yeah, love that. All right. Well, thank you so much, both of you. It's been an absolute pleasure. I could have literally spoken for another several hours, but I have a feeling that our chips are going to run out in the camera. So that's it. Thank you very much for watching. Thank you to Ben and Jack from XP Properties. And you have been watching the Property Investors Award podcast, Behind the Awards. Thank you.
Thanks for having us.
Thank you.
Thank you very much.